Indiacharts, the truth about the markets.
Indiacharts publishes Nifty daily video updates, the weekly Elliott weight outlook, and the long-short report covering all asset classes.
Hi everyone, recording for the 18th of August 2023. Let's see, I'm trying to record this podcast with a video. Maybe that will allow me to do two things at a time, which is if it's on YouTube and I do get the chance, I can throw in some charts there. But otherwise, the idea is for this really to be one of my podcast rants, which will show up on SoundCloud. And if you're using Spotify, Apple Podcasts, Google Podcasts, wherever you want to find it, if you simply search for Indiacharts, you will find the channel and you can subscribe and start following the podcast that I try to put out whenever I can. More often than not, once in a couple of weeks. I hope to do one every week, but it doesn't always happen. It's sometimes once in 2 weeks, but I do continue to do them. So if you're looking out for the notifications, just follow it on any of those channels and you will get to know about the podcast as and when I publish. Now, the markets have been pretty interesting. They've been violent. In fact, since I've written the long short report, it's actually pulled back a bit. But whatever I've written there does not really change because the long short report is big picture. Whereas in the short term, we deal with something very, very different. Now, I really waited to write that out because in any case, we were bullish. But what I wanted to do is put out a clear case of the weak dollar and reflation trade, which is something that I've been talking about since 2020. And I thought that confirmation of a weak dollar would be important. So when it broke all the lows of 2022, it was a good reason. But since then, we've seen the dollar bounce back and retrace some of those losses. A lot of those losses, it's not gone back above the high, the last swing high on a weekly or monthly chart. But it has retraced a significant portion of it, more than 80%. And therefore, you start wondering, is this a new move or is this just part of the previous move? And all this is coming on the back of rising US interest rates or US bond yields rather. A mix of both. Because bond yields are driven more by expectations and interest rates, of course, are raised by the Fed itself. The Fed has continued to tighten. To at least my surprise, I would think that they wouldn't mind keeping things a little easier, even though they do want to get a hold on inflation. They don't really want to kill growth. But what would make them do something like that? They would know something that we don't. And that apparently appears to be the strong data that continues to come out of the US economy. The GDP growth numbers have been stunning at the least. They've beaten most expectations and they actually reflect some kind of underlying phase of productivity gains that I'm also hearing about now that are really the drivers behind the scenes, which is why they're actually doing so well. So if you have productivity gains driving these earnings and then those earnings are being seen by the market, they're actually able to handle higher interest rates. And the pressure that they face really from wages also would then end up being absorbed and becomes a natural and normal demand. Now, that's a lot of macro to digest, but coming back to our markets, what it really means is, are we really going to see high interest rates in India? My sense is not, because I do think that we've already peaked in as far as interest rates in India are concerned, because the bond yields on the 10-year GSEC have already broken down from the triangular pattern. Unlike the USD INR, which is broken on the upside. Now, I don't know if you guys remember, I did have this discussion some time back that when bond yields fall, the currency weakens. Okay. And that was a risk to my view, thinking that both could go down together. When yields fall, they can trigger the currency. But eventually when, the rates pull back a bit, the currency should strengthen. Now we have seen bond yields in the 10-year GSEC bounce back a bit to the upside recently. But that doesn't seem to have caused much of a strengthening reaction on the INR or the rupee. So in the end, what we are really seeing is our response function to what is really happening around the world. So if the dollar is globally going up, the rupee is responding to that. If the bond yields are globally going up, the GSEC yields are also responding to that. The lag or lead lag is really that the dollar is not at a new all-time high, but the USD INR was as it got past the 83 mark. It started making a new record. And on the other hand, bond yields also in the US are knocking at the doors of the highs that they made in October of 2022, or for the 2-year, the significant new high readings were seen in March of 2023. Both of those occasions, Indian bond yields have not made new highs and now they're actually down. So a very, very different pattern. in both the cases, even though in the short term we seem to be moving in the direction of what is happening globally, our readings are very different. Now, if I go to the monthly chart of the USD INR, what I end up seeing is that the momentum on monthly charts is actually on the sell side. So then this spike to new highs could also end up being a false move or a fifth move that just culminates and then rolls over. So it can be slightly dangerous, but given that we've broken out beyond the 83 mark, the 83 mark could end up being a support in the short term. There could be one more spike above 83.50, and then I look at the possibility whether it tops out over there. On the other hand, for bond yields, I think they already broken down. So we have retraced more than 50% of the fall that we saw in yields, and it should be due to max maybe do 61% and then head lower again. So that is sort of what I would expect. What is that 61% level? It's at around 7.28 or 27, I think. Yeah, somewhere there, 7.28% max. And then head down from there is what I would think as far as Indian bond yields on the 10-year are concerned. And once you start seeing yields over here drop, that would be supportive, I think, of markets, even though, like I said, for currency, sometimes it can mean downward pressure for the rupee or the USD INR moving up a bit. But again, we are going to move to global cues, and therefore those relationships may not work exactly like that. In fact, if yields are falling, it probably means that our bond market is attracting funds, attracting buying interest. And as it does that, as foreign money comes into even our bond market, the rupee can strengthen. So what would drive that kind of a move into the bond market is, I think, the really big question. Now, one of the reasons could be, and it can be debated, because the differential between Indian bond yields and US bond yields is actually narrowed down to the lowest in history, which means why take the currency risk and actually buy bonds in India relative to the US. So actually the attractiveness of the Indian bond market to foreign investors is sort of reduced at the moment. Now, US bond markets have been falling and yields are spiking on the back of the expectations that the Fed wants to hike more, or that there were some recent downgrades of credit. But of course, that's the sovereign credit, and so that doesn't really matter, or shouldn't in the medium term. But what does matter is that the US, for its spending plans, does need to raise almost up to $2 trillion from the market and has to pay interest for another $1 trillion, which means for 2023, it has to do some $3 trillion of bond funding for the treasury. And if that has to come, if it comes onto the market, of course, yields will jump a lot. And that's sort of what markets are trying to debate. Is this issuance going to really cause a big jump in yields? It's not just the inflation then, though that is the talk of town. Inflation data has been falling consistently. In fact, the falling inflation data was one of the reasons why the dollar broke all the lows of 2022. And I took that as a reason to believe that eventually, if inflation is having a positive effect on the dollar in terms of wanting it to weaken, which is what I would like from an emerging markets perspective, then wouldn't it also cause yields to go down? And that doesn't seem to still be happening, So, and I think the only reason for that is US having these big issuances coming up. Now, given the sheer scale of these issuances, do I think that the Federal Reserve would just let it fall on the market? And that's where the answer appears to be a big no. I mean, first of all, if the US government needs to be funded, it doesn't need to be funded at high interest rates. It needs to be funded at low interest rates. And if you need low interest rates, the only way it's going to happen is some kind of yield curve control. If the Fed has to promise directly or indirectly to buy or fund those bonds at a lower rate for the government and provide the funding to the treasury. So as and when that happens, the pressure eases. Now, there's no announcement either from the US side as to what they will do on the bond market. Will they intervene, or have they started to buy behind the scenes? And when we actually see that buying, a couple of $100 billion of bond buying, if the Fed does behind the scenes and we see that report come out, then it would change sentiment dramatically at that front. The other one which can change sentiment dramatically is China doing what we've been hearing a lot in the news, which is some kind of a stimulus or some kind of support to its economy. Not just rate cuts, they've done that a couple of times. That's not working out that well. Of course, the Chinese market did rally last year post-COVID, but it's been falling back. And it's going to need that additional stimulus, just like most other nations have actually done post their own rounds of COVID. And I think China has probably not done that much, which is why inflation is not a big issue in China, but they're going to need to do something. And it's a pending issue. They keep saying there's a lot of news coming out of China that they're going to do something, but they haven't done anything yet. and which is why you find the Chinese market under pressure. That is one, it's a major economy. And on the other side, you find the US bond market under pressure. And if you can sort these two out, I think the risk on trades will just come rushing right back into the markets. And these just look like pending issues. It's not like, oh, this is not going to happen. It's like an obvious bet. I mean, the US is going to fund its treasury. It's not going to, let it fall on the market, because high interest rates for the government don't make sense. And so that's, according to me, a done deal. It's only a question of timing. And the timing is making all the difference right now, because the markets are panicking, thinking that, well, if it doesn't happen now, yields are rising, and reflecting a sort of immediacy, an immediate need for someone to step in and actually throw water on the entire issue, so that markets can go on doing what they want to do. Now, in the meantime, sentiment is reaching an extreme. US bonds have, if you combine all the shorts across categories, across time frames, one of the highest short positions historically. We've never really seen that. In fact, the 10-year used to have high short positions in Jan, Feb, and now you're actually seeing the 30-year add short positions recently in the recent weeks. And so if you combine it all, it's one of the biggest short positions. So sentiment is extremely negative as far as US bond markets are concerned, and it would really help a lot if we get some kind of a stimulant on that front. Similarly, on the dollar, sentiment reached almost 90% on the DSI, the daily sentiment index, which means 90% of traders were bullish on the dollar, and that's a pretty high reading. So if only 10% are bearish and 90% are bullish, it's reason to believe we're getting closer to the end. That doesn't mean you can't go to 92 or 93, but we are getting close to that point. And on the yen, we are definitely low. It's like 9%. So it's single digits. USD JPY. So the yen at 9%, meaning that there are very, very few people who are really bullish on the yen. Everybody's bearish. And that's the interesting part, which is why the USD JPY, which is one of the other major component drivers of the dollar move, should be peaking out and rolling over as well. That's the expectation I would have. And these are the things we're really watching out for, because that's the global stuff that has been affecting markets and resulting in this recent correction, especially in the large caps. And US has seen relentlessly its indices fall. Now, if you look at the pace of the fall, either in the Indian index, US indices, or in the US bond markets, it's actually much slower than the declines we were seeing last year, which is why I still think this is a routine correction. This is not a major trend reversal. And the moment some of these news items clear, we should probably see a resumption of the uptrend. And that is seen even more clearly in the mid and small cap space, where the broad market indices are really not breaking down. They're just holding their gains. Now, you can say they're losing momentum to some degree, which is a fair point, because they are narrowing down at higher levels, not moving up at the same pace as they were earlier, but they haven't broken down yet. Now, their failure to break down can be seen as, oh, well, that means there's still some correction left in the market. On the other hand, we can say that, well, their strength, where you can see individual stocks running away every day, could actually be a signal that underlying strength is very strong, and this is not a weak market. And in general, if you're an investor, your portfolio reflects that, because your portfolio is growing in value, even as the Nifty appears to be declining in value. That's sort of a blessing in disguise for people who are, especially those who are mid and small cap investors, or who invest outside the large caps, outside the A group, outside the index stocks. They're definitely doing much better than the indices themselves. So this is the run up. I think the conclusions that I can make, the summary of everything that I've observed, that we are going through a pain period that cannot be permanent, because the problems that are there are not going to be allowed to become widespread, contagious. And therefore, I think it warrants action from governments, central banks, and so on. And it's coming, so it's only a question of time. When we look at the internal structure of the Indian markets, it has been strong and it remains strong. So you might get rotational corrections in individual sectors, like we have seen that in banking recently. We've seen it in a couple of others, individual stocks as well from time to time. But overall, something or the other keeps performing and keeps this gravy train going. And therefore, if you focus on stocks, you're good off over there. If you're really got to deal with Nifty, you'll have to do it level to level. And the two will have to be thought of very, very differently. If you think about the Nifty's falling and you expect stocks to fall, it may not exactly happen that way, especially if you are linking what's happening in the cash market to the large caps and F&O category. So that's all in this update. Hope that gives you sufficient insights to think about what is going on and how to deal with it. My sense is I'm just waiting for these pressure points to go so that we can get back to the bull market that I don't think is completely done with. We've seen a good pause at the index level, but that's about it. Lots more to come. A lot more action shows up once you get the funding lines in place and liquidity movements in place, and things start moving ahead all over again. That's it. Thank you.
Nothing in this podcast is investment advice. Views on financial markets are in good faith to expand your understanding of how markets work. Please consult a registered financial advisor for the same.
And yes, please share this podcast with everyone you think can benefit from this knowledge.